Thank you, Grant. That's definitely going to be a tough act to follow. And even harder if we cannot scroll. There we go. All right, good morning, everybody. My name is Christine Keener, and I joined the Barrick team 2.5 years ago to lead the North American region. I also have the pleasure of having Henri Gonin, who is the Managing Director of Nevada Gold Mines, to be presenting with me this morning. As you all know, North America is Barrick's value foundation. In this presentation, Henri and I will emphasize the key areas that make North America this value engine, highlighting our accomplishments since the last Investor Day 2 years ago, and where we will be focusing our efforts going forward to deliver value now and drive growth for the future. There is nothing more valuable than human life, and no ounce is worth producing to the detriment of safety. As you heard from Grant, and we'll see in all the regional presentations, we have fully embarked on our journey to zero. As a region, we have steadily improved our safety performance over the last 2 years. Since January of 2022, both our lost time injury and total recordable injury frequency rates are down 53% and 35% respectively. We are also seeing a decrease in incident severity, and I am very proud to report that in the current year, we had 6 months lost time injury-free as of the end of October. We focused much of our efforts on our safety culture, recognizing that while it's critical to keep track and to learn from lagging indicators, incident prevention and driving safety performance begins with a sharp focus on leading indicators. Specifically, we are concentrating our efforts on critical control verifications, close calls, and corrective actions. And as you can see on the slide, we are already making significant progress with these metrics. In Barrick North America, we own and operate the largest gold mining complex in the United States, which is also a world-class ore body whose value is unlocked by world-class people. While we are still working to improve our labor efficiencies, North America produces 46% of the company's gold, or as you can see on the pie charts behind me, 36% on a gold equivalent basis, despite having only 19% of the workforce, given our high grades. We also have a proven track record of reserves replacement. Not only have we replaced the mine reserves since the inception of the Nevada Gold Mines joint venture, we have also added 11.5 million ounces of inferred resources as at the end of 2023. We've come a long way as a region since our last Investor Day, and we've accomplished much of what we had outlined back then, such as the reserve and resource replacement that I just mentioned, growth of our exploration portfolio that I will touch on later, and optimization of the closure sites to reduce our liabilities, as Grant highlighted. Key to our success, given the life of mine extensions that we have delivered and continue to do so, is having to reinvest in our infrastructure and equipment to extend their useful life and capture efficiencies. Examples of this are the successful completion of the Gold Quarry expansion project to increase throughput by 20%, and the successful conversion of the Gold Strike autoclave from resin and leach to carbon and leach to enable higher recoveries, lower unit costs, and earlier processing of material from Carlin South. We also invested significantly in underground development, bringing in contractors to accelerate this progress. In our open pits, investments in 63 new Komatsu trucks, 47 of which have been delivered, are increasing the average payload per truck by approximately 15% and improving availability by 7 to 25%, while materially lowering maintenance spend. From a project standpoint, we received the Record of Decision for Gold Rush in Q4 of last year and have since been ramping up construction of the associated infrastructure and vent shafts that enable increased mining rates. Additionally, we received the Record of Decision for Robertson last week and are now working to capture the full value of that project. Also of note, the TS solar plant was completed on time and on budget in Q3 of this year. The full 200 megawatt array is now in operation, with commercial production expected to be declared later this month. Turning now from what we have achieved to what we will be focusing on moving forward. Gold Gold Rush is an obvious value driver for us. Continuing its ramp up to the 400,000 ounce per annum production rate is a key imperative. Also, 4 Mile, which is wholly owned by Barrick, is a significant asset of material strategic importance that Simon will highlight later. And as Mark mentioned, I'm sure a lot of you saw the press release on it and already know some of the good news. We have certainly not been shielded from the post-pandemic inflationary environment. To offset cost pressures, we will be relentless in our pursuit to drive efficiencies, investigate innovation and automation opportunities, and importantly, develop our people through the Training Mine and Barrick Academy. We are also implementing One Mine to provide real-time data that will enhance decision-making and operational performance, which Seb will talk about later in more detail. We are proceeding with fit-for-purpose investments in projects that are required to recapitalize the business and enable our growth. That growth will be driven further by our significant near-mine potential and value-adding gold and copper discoveries. Of course, nothing is possible without the support of our host communities. That is why we strive to be the mining partner of preference, strengthening our social license through engagement, sustainable investment, and partnerships. One example of sustainable investment and partnership is our commitment to solar energy in Nevada. In addition to this TS solar plant, NGM is embarking on site solar generation and battery storage facilities at Turquoise Ridge and Cortez, for which we recently received a cost-share award from the Office of Clean Energy Development for $14.6 million for Phase 1, with a total award of $95 million expected. As mentioned, and as Graham will discuss later, we have not been shielded from inflation. The weakening dollar, while it helped with gold's momentum and record-breaking prices, further impacted our costs for commodities sourced outside of the United States. It is important to note that the costs on these graphs are on a dollar per ounce basis, and therefore partly a reflection of the fewer ounces produced since 2021. Further, while our spend on consumables and maintenance spares has increased, this has been affected by a larger proportion of refractory ounces in the sales mix, from 68% in 2021 to 74% in 2024, which requires more reagents to unlock the gold. Additionally, we've invested significantly in our infrastructure, which is partly reflected in the maintenance spend due to some of the costs not being classified as capital. Given the decrease in energy costs from the 2022 peak, energy shifted from 15% of our cost base to 9% in 2024. We will share the key actions we are taking to reverse this upward trend and drive down operating costs throughout the remainder of this presentation. Looking at the 5-year attributable profile for North America, Cortez is driving the step change in 2027, owing to Crossroads being primarily an ore following the stripping of Phase 6 that we are in currently, combined with increased production from Gold Rush. Our 5-year profile is dynamic. We previously disclosed a wall failure at the Gold Quarry open pit earlier in the year, which delays some near-term ounces as we redesign the pit. It is also reflective of open pit optimization work completed to maximize long-term value. Ari will more fully explain this effort in our open pit strategy. We are making investments in our business to set the operations up for longer mine lives and improved efficiencies. As these investments pay dividends and we return to our natural sustaining capital run rate, as well as increased production, unit costs are projected to taper off and margins to significantly improve. I will now turn it over to my colleague Ari, who will dive deeper into the sustaining capital profile for Nevada Gold Mines and highlight the NGM operations.
Thank you, Christine, and good morning, everyone. My name is Henri Gonin. I'm the Managing Director of Nevada Gold Mines. I started my career in South Africa in the 90s, and I've been working in Nevada since 2005. As you know, Nevada Gold Mines is operated by Barrick, and we own 3 of the top 10 Tier 1 gold mines in the world, and we are still one of the largest employers in the state of Nevada. We are also the largest gold-producing complex in the world. I'm going to start the conversation today by discussing capital. The graph above shows the historic sustaining capital spend for the complex. And you can clearly see that both partner companies underinvested capital from the years 2014 to 19. Since the formation of the joint venture, we have been and will continue to systematically reinvest in the facilities and the fleets to address the long-term impacts of that underinvestment. This is shown in the hatched portion on the stack bars. To secure that healthy future for our ore bodies, we must improve our plant reliability in the roasters and autoclaves and reduce our operating costs. Many of those projects are classified as sustaining capital, although they increase capacity. And as an example of that is the de-bottlenecking project that we completed in the third quarter at Gold Quarry Roaster. That unlocked a 20% increase in capacity for us compared to what it was before the joint venture. When we consider our depreciation and amortization rates of our assets, and we use that as a baseline to determine a healthy, sustainable capital run, we are targeting that $250 per ounce investment line, and that will include sustaining capital, development, stripping, and then drilling capital. In order not to fall in the same trap as that 2014 to 19 era, we do expect to be spending more than that for the next 3 years, and that's focused in 4 key areas. The first is the reinvestment projects, and examples would be the Juniper Mill carbon stripping circuit, the Gold Quarry Roaster crusher project, autoclave boiler refurbishments, and then the remaining commitments on replacement fleet. Second, additional projects that deliver growth to our mines, but they do not qualify under our financial guidelines to be categorized as growth. Those would be Turquoise Ridge's paste plant and a Meikle paste plant and the East Carlin portals. And then third, increased development rates in our underground mines ahead of stope production. This will secure increased levels of flexibility, and it is required to facilitate the increased ounce production from underground sources in the near future. And finally, active grade control drilling programs to further drive down the variability in our models. There is no doubt that North America, and particularly Nevada gold mines, is the value foundation for Barrick, and that's why we focus on fit-for-purpose investments to continue delivering value to those shareholders. With that said, and as you know, we suffered that pit wall failure in the Gold Quarry pit during the first quarter of this year. Our subsequent actions were to pivot the mining fleet to the South Arturo pit, and that impacted ounce production for us, and costs, because it effectively brought forward stripping costs into 24. Now, looking forward then, we have to consider a few things. The first is the longer-term impact of the wall failure and the improved understanding of the geotechnical constraints around that pit, and then the impact that that has on strip ratio and costs and ounces. The second is objectives and impacts of our reinvestment projects, specifically making sure that we can realize the benefits in the open pit fleets and in the roaster projects, and that means driving down operating costs. And then the third is we have the current inventory that we carry in our long-term stockpiles in the open pit in front of the roasters. Well, that forces us then to make a decision on whether we're going to continue driving the previous ounce profile, which would be at a much reduced value, or recut the open pit business to balance our ounce profile and costs and to sustain value delivery. And on that note, it is worth highlighting that NGM has distributed $9.2 billion to its owners since the JV inception. Selecting value generation then, our strategic actions have shifted in 3 primary areas. And the first is we adjust the open pit mining strategy. And we do that by mining at the appropriate rate that will limit the growth in stockpile volumes and hence limit locking up additional working capital. We reduce the operating cost of the mines by retiring old equipment and increasing efficiency that comes with the newer technology that the new fleet brings, and we embark on an automation strategy. The second is we will continue to expand capacity in the production of our underground ounces by driving development. And as you can see on the graph on the top, the split in underground and open pit ounces shifts from approximately equal contributions now to a 2/3, 1/3 ratio in the next 5 years. This is currently being accelerated by third-party contractors in several of our mines. However, with our retention rates improving a lot and the continued expansion of our training mine facility, we are working on converting more of those mines back to owner-operated development and therefore drive the cost down. And then thirdly, we strategically adjust capital expenditures to catch up, number one, and then to sequence with a revised ounce profile without falling in the same trap as the 2014 to 19 era. So what does this mean for us? Over the next 2 years, this results in fewer ounces produced compared to the previously disclosed profile. However, we expect to sustain free cash flow generated on the back of the lower open pit and roaster operating costs and deliver higher margin ounces while we manage our capital spend rate. The graph at the bottom shows the projected ounce profile going forward. The yellow line depicts the arithmetic sum of the combined partner plans at the time when the joint venture was formed. If you compare that to the current profile in blue, you will see that we have successfully replaced our ounces that we have mined. And this clearly supports the focus on value, and not just for the next few years, but well into the future. And it underscores our ability to remain agile in responding to changes in our business. The grey shaded area is our opportunity to bring forward ounces into the years from 11 to 20, and to sustain a 3 million ounce production rate, with Hanson and North Leeville and 4 Mile as the primary opportunities. On NGM then, we have significantly improved since inception. We continue to see improvements in our efficiencies and in flexibility in our mines, and we continually strengthen our team. Carlin and Turquoise Ridge will both deliver near the lower end of their guidance for this year, while Cortez will finish near the top and Phoenix around the middle. That'll keep us on track to deliver ounce production within guidance for NGM, albeit at the lower end. Increased stripping costs following the pivot from Gold Quarry to South Artero and the infrastructure repairs combined with the ounces at the lower end are expected to drive our costs up above guidance. Within NGM, the 2 Carlin roasters are our primary ounce producers. Both Carlin and Cortez deliver refractory tons to these facilities. For us to maintain a steady increase in our production over the next 5 years, we need to remain flexible as an organization. And rather than trying to optimize each mine on its own, in the subsequent slides, you will see that our production profiles for Carlin and Cortez are variable from 1 year to the next, but overall, we project a steady increase. And as discussed on the previous 2 slides, we decided to continue driving value to the partners rather than delivering ounces at any cost, and hence the reduced profile for the next 2 years, while we will maintain free cash flow and continue to complete the work scopes on those reinvestment and operational improvement projects. The major impacts on the optimization work for the next 5 years comes then from Gold Quarry and Crossroads. Carlin is the largest gold producing hub in the world, and when you consider the mining and the combined processing infrastructure. Several events this year had impacted our production, notably the high wall failure, but then also Carlin ounces got displaced by higher grade Cortez tons, which benefited NGM overall. The reinvestment in the open pit fleet continues, and to drive further reductions in cost, we identified 40 pieces of mining fleet that are now in various stages of being shut down and retired. And in accordance with the revised mining strategy, we are also be able to reallocate the associated operators and maintenance personnel to other areas in NGM where the current vacancies exist, and thereby we reduce our overall headcount and we increase efficiency. Additional to the fleet rationalization and the open pit mine rescheduling, we also continue to achieve increased efficiencies in our underground mines. With completion of the Gold Quarry Roaster project, then we also lower overall operating costs. In support of our development efforts, we have successfully completed the first phase of a new portal into the Piet Bajo and Rita K sections of the portal mines, providing the required ventilation to secure the ounce production as planned and increasing efficiencies through improved logistics. The dip in the ounce profile for 2027 for Carlin is offset by a spike in the ounce profile for Cortez in the same year, and you'll see that on the next slide. We have stripped Cortez pits into delivering ore, and we've also completed a direct haul road up to the Cortez Hills open pit buttress. That reduces our requirement for rehandle and obviously then reduces cost. The Gold Rush underground ramp up, as already said, is continuing on track, and our first ventilation shaft is now nearing completion. The graph at the bottom there is included to illustrate the impact of the investment in the replacement haul truck fleet, and you can see the inflection point at the unit cost per ton happening in 2023. The subsequent downward trend is as a result of shutting down the old and more expensive and less reliable equipment, which was the plan, but then furthermore realizing higher than expected efficiencies, allowing us to shut down additional trucks and to relocate them to Phoenix. Cortez will continue to grow through spectacular opportunities like 4 Mile and Hanson in the Cortez Hills Underground and Swift on the west side of the valley. Moving to Turquoise Ridge, this is one of the highest grade underground mines that exist. It also makes it a low-cost operator. We started the year with challenges throughout the mine, and we have been systematically dealing with these, leveraging the broader experience across Barrick, and we are seeing significant improvement in the performance right now. Similar to Carlin, the reinvestment projects completed at the Turquoise Ridge Sage Mill started to deliver lower operating cost and much improved reliability. And if you combine that with the underground improvements we are seeing, it puts us on track to deliver a very strong fourth quarter. Future growth potential includes extensions along the main mineralization controls supported by a refined new geologic model at Turquoise Ridge Underground and expansions in the mega open pit. Then at Phoenix, we are in the final phase of completing a sulfur concentrate plant that will treat and extract sulfur from the tailings stream. This sulfur concentrate produced here will be shipped over the road to Carlin to be burnt as a supplemental fuel in the roaster, further reducing the operating cost through Gold Quarry. The increased efficiency of the new operating fleet at Cortez enabled the relocation then of 4 trucks and their crews to Phoenix, and that delivered increased copper production for us. We have now also embarked on finding future expansion opportunities at Phoenix, and there are 2 specific targets that we are exploring and studying now. Copper Basin, which is a high-grade copper-gold deposit, and Copper Canyon, which is a porphyry. And I'll hand it back to Christine now.
Thank you, Ari. Our Canadian operating mine, Hemlo, is on track to deliver near production guidance. However, costs are now expected to be above guidance on the back of higher royalties and production at the lower end of expectations. Hemlo is a steady producer with a new site leadership team that is focused on improving efficiencies to maintain healthy margins. In 2022, we announced that we were studying a new, larger open pit, and those studies are now focused on optimizing the size of the pit to maximize the value of the project. While those studies progress, we are concurrently advancing permitting. Further, we have a significant drill program planned for next year to extend the life of the underground. Moving to Donlin, our pipeline project in Alaska and a 50-50 joint venture with NovaGold. The focus over the last 3 years has centered on building ore body knowledge around the controls and mineralization. The current work streams are targeted at moving the project up the value chain. And as such, the work program includes updating the resource model, progressing mine planning, optimizing the power sources and infrastructure, completing a cost update, and advancing the remaining permitting. An infill drilling program is planned for 2025 to refine the mine planning assumptions, along with some conversion drilling. In conjunction with the state of Alaska and our Alaska Native Corporation partners and resource owners, we are exploring a power solution for the project with the potential to contribute to a regional and statewide energy solution. At this event in 2022, I introduced the tailings reprocessing project at Golden Sunlight in Montana. This project is a great example of how, with some creativity and engineering, we were able to turn a liability from a closure property that ceased operations in 2019 into an asset, providing a valuable fuel source for the Carlin roasters. Since the start of production, around 49,000 tons of concentrate were produced and delivered to Carlin, which is equivalent to approximately 22,000 tons of pure sulfur. Once mining of the tailings has been completed, we will have reduced the environmental liability by approximately $80 million and eliminated the need for perpetual water treatment. Barrick's DNA and ability to deliver on our promises is underpinned by our world-class people. We are committed to addressing our need for skilled trades and mining professionals by fostering strong relationships and actively engaging with key trade schools, the military, and universities. We significantly reduced our turnover rate from the pandemic highs, and to ensure we retain that talent, we developed various programs to provide our workforce with opportunities to grow and develop within the organization. We expanded the training mine, and early next year, we will be launching the Barrick Academy, which you will hear more about from Seb. Given the high cost of labor in North America, we continually seek ways to optimize labor and reduce costs, such as the Carlin open pit optimization and subsequent redeployment of the workforce that Ari noted. At Barrick, we are committed to being a positive and responsible presence in the communities where we operate, and central to our strategy is meaningful engagement at every stage of our projects, from exploration to closure. We work hand in hand with communities to understand their needs, listen to their concerns, and support initiatives that foster sustainable development and long-term prosperity. Through our community development and engagement strategy, we prioritize 5 key investment areas: education, environment, economic development, cultural heritage, and health. This slide lists only a selection of our many initiatives. The picture on the slide is a rendering of the long-term care facility in Marathon, Ontario, near our Hemlo operation, for which Barrick invested $1 million Canadian to fill a critical gap in the care continuum for surrounding communities, including First Nation communities. Pivoting now to growth, where we are actively expanding our exploration portfolio to look farther afield into other well-endowed belts for both gold and copper, while also delineating future growth drivers to extend our current assets. Simon and Joe's presentations will provide more detail to show you that the North America portfolio is a balanced investment towards future growth that will sustain the business for decades to come. In closing, I wanted to show you our 5-year production profile one more time to highlight the growing trend in our production in the coming years, a trend you will also see in the other regions. I firmly believe, and hopefully this presentation has convinced you, that despite some challenges, we have significant runway ahead of us to further improve and grow our North American business and create tremendous shareholder value. Thank you, and I will now turn it over to Mark Hill.